Elon Musk, Jeff Bezos, Jay-Z, they're household names, synonymous with 9-figure yachts and sprawling estates. But here's the twist. Instead of swimming in cash, they're often swimming in IOUs. For most of us, debt is the villain of our financial story, the monster under the bed that keeps us up at night. We're taught to fear it, to pay it down, to avoid it at all costs. But for the ultra-rich, debt isn't a monster, it's a powerful tool, a secret weapon. They treat it like an all-access backstage pass to wealth creation. With it, they can skip the tax line, enjoy an interest-only lifestyle, and watch their asset columns climb relentlessly higher. Today, we're not just glancing at their highlight reel. We're stealing a look at the actual playbook they don't post on Instagram, the one that explains how they use debt to get richer. Imagine for a moment you're a tech founder, and you're sitting on a cool $1 billion in company stock. It started as a garage project, and now it's a global force. You want to diversify or maybe just buy a private island. If you decide to sell just 10% of your stock, that's $100 million. Uncle Sam is immediately going to show up with his hand out, ready to take his cut in the form of capital gains tax, which can be upwards of 20%. Suddenly, your $100 million windfall is down to $80 million before you've even picked out a beach. But the wealthy play a different game. Instead of selling, you walk into a private bank, not as a borrower begging for a loan, but as a valued partner. You offer to pledge a portion of your stock portfolio as collateral. In return, the bank extends you a securities-backed line of credit, or SBLOC. You don't have to fill out mountains of paperwork or get a credit check, because the loan is secured by your valuable assets. The bank sees it as low risk and offers you a highly competitive interest rate, maybe around 2 to 4%. Now you have millions in cash to spend, and you never sold a single share. Your $1 billion stock portfolio remains untouched, hopefully continuing to appreciate at its historical average of, say, 8% per year. The real magic happens in the gap between your loan's interest rate and your portfolio's growth rate. That difference is essentially free money, compounding year after year. And the best part, the entire transaction is a non-taxable event. Since a loan isn't considered income, you don't pay taxes on the cash you receive. No sale, no realized gain, no tax problem. It's crucial to understand that not all debt is created equal. The Billionaires playbook is built on a foundation of good debt, which is fundamentally different from the bad debt that ensnares so many people. Bad debt is what most of us are familiar with. It's the high-interest credit card balance you carry after buying a new wardrobe or the latest smartphone. It's the loan for a fancy car that loses 20% of its value the second you drive it off the lot. This kind of debt finances consumption and depreciating assets. It takes money out of your pocket every month and makes you poorer over time. It's a fast lane to financial stress and buyer's remorse. Good debt, on the other hand, is the secret sauce. This is debt taken on to acquire assets that generate income or appreciate in value. Think of a loan to buy a rental property where the tenant's monthly check covers your mortgage payment and then some, or a business loan to launch a software-as-a-service company that brings in recurring revenue, or even borrowing to invest in a boring, unsexy logistics company that nobody tweets about, but that reliably churns out cash. The golden rule is simple. If the asset you buy generates a higher return than the cost of the loan, the debt has just become your silent business partner, one who works 24/7 and never asks for a raise. It's a tool for leverage, allowing you to control a large asset with a small amount of your own money. Real estate is the classic textbook example of good debt in action, and it's where many fortunes, large and small, are born. Let's break down a simple scenario. You find a duplex for sale for $500,000. You don't pay for it in cash. Instead, you put down 20%, which is $100,000. You take out a mortgage for the remaining $400,000. Now you have tenants in both units, and their combined rent is more than enough to cover your monthly mortgage payment, property taxes, insurance, and a budget for repairs. The property is generating positive cash flow from day one, but the magic doesn't stop there. While your tenants are paying off your debt for you, the property itself is likely appreciating in value. Let's say it creeps up by a conservative 6% a year. On top of that, the interest you pay on the mortgage is often tax deductible, further reducing your overall costs. Think about the return on your actual cash investment of $100,000. When you factor in the cash flow, the appreciation of the entire $500,000 asset, and the tax benefits, your cash-on-cash return can easily soar past 20% annually. You are effectively using the bank's money to get rich. Now imagine scaling this. Do it with $10, $100, $1,000, and you'll quickly understand why real estate remains a cornerstone of wealth for so many on the Forbes list. If real estate is the training ground, the leveraged buyout or LBO is the Billionaire's turbo button. It's the same core principle, using debt to acquire an asset, but on a much grander, more complex scale. Here's how it works. A private equity firm identifies a target company, let's say a well-established but sleepy widget maker that has steady cash flow but isn't growing much. The firm decides to buy it for $5 billion, but they don't use their own money. Instead, they might put down just 10% of the purchase price, or $500 million of their investors' equity. For the other $4.5 billion, they go to a consortium of banks and borrow it, using the assets of the widget company itself as collateral for the loan. The private equity firm now controls a $5 billion company with only $500 million of its own skin in the game. Over the next 5 years, they don't let the company stay sleepy. They install new management, streamline operations, cut costs, and push for growth. All the while, the widget company's own profits, its cash flow, are used to aggressively pay down the massive debt that was used to buy it. After 5 years, a significant portion of the debt is gone. The company is now leaner, more profitable, and worth, say, triple its original value. The firm sells it for $15 billion. After paying off the remaining debt, the original $500 million equity stake has ballooned into a multi-billion-dollar profit. This is how a 10% down payment can generate returns of 5x, 10x, or even more. Elon Musk's acquisition of Twitter, now X, was a high-profile remix of this strategy, where he used a mix of bank debt, investor equity, and massive personal loans backed by his Tesla stock to take the company private. This brings us to the ultimate multi-generational wealth strategy, one that is both morbidly named and brutally effective: buy, borrow, die. It's a 3-step process that allows the ultra-rich to fund their lifestyles, and their heirs' lifestyles almost entirely tax-free. Step 1, buy. This part is simple. You acquire assets that are designed to grow in value over the long term. Things like a diversified portfolio of stocks, real estate, fine art, or private businesses. The key is that these assets appreciate faster than inflation. Step 2, borrow. As these assets grow in value, you need cash for living expenses, new investments, or that 9-figure yacht. But you never sell the assets. Instead, you do exactly what we discussed in Section 1. You take out a low-interest portfolio line of credit against your ever-growing holdings. This gives you a constant stream of tax-free cash to live on, because borrowed money isn't taxed as income. You simply make interest-only payments, or let the interest accrue, knowing the value of your assets is growing faster than your debt. Step 3, die. This is the final and most crucial piece of the tax avoidance puzzle, under a long-standing U.S. tax rule called the stepped-up basis. When you die and pass your assets to your heirs, the original cost basis is stepped up to whatever their market value is at the time of your death. This means all the capital gains that accumulated over your entire lifetime are legally and permanently erased. Your heirs can then sell some of the inherited assets, pay off the outstanding loans, and continue the cycle, all without ever paying capital gains tax on decades of growth. It's the ultimate dynasty building loop funded by smart debt. The entire system of using debt to build wealth is supercharged by the tax code itself. The U.S. tax system is designed to incentivize certain behaviors, and borrowing for investment is one of them. While the Internal Revenue Service, or IRS, doesn't consider the principal form of a loan to be income, it often allows you to deduct the interest paid on that loan as a business or investment expense. Let's unpack that. It means you can use borrowed pre-tax money to acquire an asset, and then the government gives you a tax break on the cost of that borrowing. It's a double benefit. You're using other people's money to buy something that makes you money, and then you can write off the cost of using their money. This isn't an accidental loophole, it's a feature of the system. Wealthy individuals and corporations spend billions on lobbyists to ensure these favorable provisions for investment-related debt remain firmly embedded in the thousands of pages of the tax code. For the ultra-rich, these tax savings aren't just a minor perk, they are a significant source of capital, a powerful fuel that makes every leveraged investment even more profitable. The savings generated here can easily dwarf what an ordinary person earns in a lifetime from a paycheck. While we often hear stories of self-made billionaires, the reality is that a huge portion of extreme wealth begins as an heirloom, not from pure hustle. A 2025 Oxfam report highlighted that a significant amount of billionaire wealth is inherited. In fact, other research has pointed out that for the first time since 2009, every billionaire under the age of 30 inherited their fortune, signaling the start of a massive wealth transfer. This inherited wealth acts as a massive accelerator for the debt strategies we've discussed. Consider a 25-year-old who inherits a billion-dollar stock portfolio from their family. They start life not at zero, but with an immense pile of collateral. They can immediately walk into a private bank and borrow, say, $50 million a year for life without ever touching the principal. They can use that money to fund their lifestyle, start their own ventures, or pursue any moonshot idea that catches their fancy. Meanwhile, the original billion-dollar pile keeps growing and compounding in the background, likely outpacing the low-interest debt. The wealth is on autopilot, generating liquidity and opportunity for the next generation. It's a self-perpetuating cycle where the advantages of birth are converted into an unending stream of tax-free capital. The numbers behind this phenomenon are staggering and almost difficult to comprehend. According to one report, global billionaire wealth jumped by $2 trillion in 2024 alone. The total number of billionaires worldwide is now over 3,000, with a combined wealth of more than $16 trillion. And this is just the beginning. We're on the cusp of the largest intergenerational wealth transfer in history. Over the next 20 to 30 years, it's estimated that the top 1,000 wealthiest families will pass down roughly $5.2 trillion to their heirs. Some estimates for the total transfer are as high as $84 trillion. Every single dollar of that inherited wealth in stocks, real estate, and business is another dollar that can be collateralized. It creates an ever-expanding, self-replicating pool of untaxed liquidity that is constantly hunting for its next acquisition, its next deal, its next LBO. The financial snowball doesn't just get bigger, it absorbs the entire mountain. Hearing these numbers might make the strategies feel impossibly out of reach, but the underlying principles can be applied by almost anyone, just with fewer commas. You don't need a private jet or a Swiss banker on speed dial. It can start simply. Open a taxable brokerage account at a firm that offers portfolio lines of credit. Many major brokerages do, with minimums that can be as low as $25,000. Instead of picking individual stocks, you can buy a broad, low-cost index fund that tracks the entire market. Let it sit, let it marinate, let it grow and compound over several years. Once you've built a decent-sized portfolio, you can take out a modest loan against it. The key is to use that borrowed money for a good debt purpose, a down payment on a rental property, seed money for a side business, or even just more diversified investments. Never use this line of credit to fund a vacation or buy a depreciating asset. Always keep your loan-to-value ratio low, well under 50%, to protect yourself from market downturns and avoid a dreaded margin call. The math works exactly the same. You're using a low-interest loan backed by an appreciating asset to acquire another appreciating or cash-flowing asset. You're building wealth with leverage, just like the billionaires do. If this deep dive flipped your view of debt upside down, make sure you smash that subscribe button. We have more stories that pull back the curtain on how wealth really works on the way. And don't forget to grab the free checklist in the description below. It outlines 5 simple steps to structure your first good debt deal and get your own personal wealth engine humming. Debt isn't inherently evil. It's a powerful tool like fire. In the hands of the undisciplined, it's a destructive anchor that can sink your financial life. But in the right hands, wielded with knowledge and a clear strategy, it's pure jet fuel. Billionaires aren't afraid of debt. They've simply mastered it. They know which side of the handle to grab. Your next move isn't to run from loans or cut up your credit cards. It's to learn how to use debt strategically, to point it at assets that appreciate, that generate cash flow, and that ultimately pay you back one smart purchase at a time.